Good afternoon. Good afternoon. That's better. Hi, my name is George Abernathy. I am the CRO at FreightWaves. I want to thank everybody for joining us on President's Day, and wanted to apologize. We are live streaming, and so that means we had to bring the curtains down a little bit. I was hoping that this beautiful view would allow you to be distracted from my lack of ability to provide the wonderful content that we have for you today. But as CRO at FreightWaves, I've been at FreightWaves for about a year and a half now, and responsible for all of our revenue and commercial operations. Prior to being with FreightWaves, I've been on both the asset, non-asset, and technology side of the industry, including a stint of about 12 years at Transplace, the 3PL, 4PL in the industry. The last 6 of those years I was president. I'm going to let my cohorts introduce themselves, and then I'll come back and I'll work our way into our presentation. Tom?
Thank you, George. My name is Tom Mallon. I am the Vice President of Financial and Trucking Freight Futures Markets. I've been with FreightWaves now about almost a year and a half, joined in October 2017. My background is in commodities, as well as running market data businesses for a number of large market data vendors. So I'll introduce Addison now.
Good afternoon, everyone. My name's Addison Armstrong. I am one of the newest employees at FreightWaves. I joined about 2 weeks ago from JP Morgan. My role at the company now is to lead our efforts on the trucking freight futures side in the sales and marketing of that product. George has done such a good job marketing it to the industry for the past year. I feel like I don't have that much to do on that side, but we have a lot of work to do, trust me. And I'm also focused on bringing more liquidity to the market through the banks and the broker-dealers and the hedge fund community. Prior to joining FreightWaves, I was with JP Morgan, where I was in charge of marketing in North America for the commodities clearing clients. Before that, I worked at an independent brokerage. Before that, I ran energy clearing sales for ADM Investor Services. And before that, I traded commodities for a couple of different large trading houses. Again, thank you all for being here this afternoon. I'm going to turn the mic over to George.
Thank you, Addison, and thank you, Tom. Going to bridge from that. As Addison described, we have been evangelizing the futures marketplace that, as is shown on the slide, will become a reality on March 29th of this year. And going a little bit further into my background and why I'm standing here. When I was at Transplace managing $5 or $6 billion worth of other people's transportation, other people's freight, Craig Fuller, the founder and CEO of FreightWaves, and I had known each other for a number of years, and he was at that point in time starting to solicit industry folks for their interest in and the concept around freight futures, trucking freight futures. And as I have been wont to say, he had me at hello. The ability to de-risk a portion of those billions of dollars of transportation that we were managing would have been and now will be an extraordinary tool that industry folks can utilize, and we'll talk about the other places where there'll be significant amounts of value being driven by this. So as shown on the opening slide, March the 29th is our opening day, and talk a little bit about who and why right now. FreightWaves is building the community that will use data and technology to understand, react, project changes, and to de-risk the market. That part, as I described, of why it was as significant of interest to me of de-risking is obviously a big component of what's being provided. And the why is to empower this freight community that's struggling to deal with the risks and the significant volatility of being exposed to freight and exposed to the freight markets with data, insights, and actionable tools. So in order for this to work, let's try to define the market size and the opportunity. So let's define the market size by doing a comparison to some of the other futures markets that are out there. WTI crude oil futures has an underlying industry size of about $421 billion. The Henry Hub natural gas futures are about $138 billion in their underlying industry value. In power and electricity futures, $390 billion in the underlying industry. All of those have demonstrated well enough and significant enough scale to be able to make the contract market work. So what does that mean for the market opportunity in freight? The trucking market valued at nearly $750 billion, larger than any of those that I just spoke of, larger than any of the others as shown, and you can see in their industry size here on this slide. Now remember though, the futures markets operate in multiples by their nature. So that while we describe $726 billion or over $750 billion now in 2019 dollars of being available, because of the multiples, you're looking at the theoretical size of this futures market of trading of upwards of nearly $3 trillion. And I didn't do housekeeping beforehand. Tom, Addison, myself, and some of the other participants today will be available for questions at the end. So Q&A will be wide open to you. So talking more about the market itself and why will this freight futures market have this great likelihood of significant success, the physical commodities that make up the majority of goods being moved by surface transportation, 84% have futures traded against them. So the majority of goods that are transported already are being traded and having futures traded against them. Trucking is the largest mode of transport in the US and grows slightly faster than GDP. So you can see here, as you can read it, truck, railroad, pipeline, water, air. The truck is the largest and continues to grow faster than GDP. So the market itself will have well enough scale and continue to grow to allow that scale to increase. So let's talk a little bit more about the industry and its sizing. The transportation costs represent about 8% of US GDP. Put that in another perspective. Freight is a larger cost of goods sold than energy in many sectors, most of the sectors of the economy. And this one, and I think we'll reiterate this later on in the presentation as well, 40% of the S&P 500 companies have stated that freight and their transportation costs, related transportation costs, are their most substantial risk to earnings. I have a number of industry contacts within the shipper community, the folks who manufacture. Shippers, sometimes you think of maritime, but shippers, as we describe them, are the folks who manufacture, distribute, the folks who are putting the freight onto trucks. There are a number of those companies in retail, CPG, and others that in 2018, because of the volatility and the significant impact that the increase in transportation costs that they got hit with, there were impacts to personnel at many of those organizations, and those organizations are looking significantly now for a different and better answer to doing the same thing over and over again and expecting a different result. When you're building this kind of market, when this kind of market is being established, you need to have volatility to make there be a reason to participate. And as shown here in the FreightWave sonar slide, you'll see that over the past 5 years, volatility is significant. If I drew a line from the low point up to the highest point there in 2018, you'd see a greater than 60% increase in what pricing and what the costs were inside the spot market. That, obviously, we've come down from that. But more important than just that straight line of how large, how big has that delta been, is look at the amount of volatility in there and the lack of predictability around that spot market that caused as much instability and challenges for those shippers, carriers, and intermediaries in 2018. So what are the drivers of volatility? Essentially, with all of these things that I'm showing you here, the answer is almost everything will cause the freight market to have some level of volatility. We've got government regulations. You'll hear us talk about electronic logging devices being one of them. Seasonality, weather, the market trends, the e-commerce effect. Freight markets are impacted significantly, and volatility can result. Why now? Why is today the right time? As I said 3+ years ago, Craig Fuller had me at hello. Why now? Well, let's think about some of the things that are different now and why now is the perfect time for this to occur. The ubiquitous telematics devices that are out there. I don't want to go crazy and pick up the mobile device here, but the mobile device that exists now in every driver's hand, everywhere, that data is now available and is no longer being put onto a server that is residing and is resident inside my organization. That data is now being pushed to the cloud, making the ability for that to interconnect with any number of systems and have that visibility and transparency be shared. And so that's where technology today, even better than where we were 3 years ago, makes today and why now the right time. What are the market forces that are around and impacting us now? I talked about government regulations, ELDs, for those who are not within the industry. ELDs, the electronic logging devices, which were implemented at the end of December 21st of 2017, and then in April of 2018, there was the regulations were being enforced. Those electronic logging devices replaced in the truck the paper logs. And in a paper log, you had a bit more, how should we describe it, flexibility in the number of hours. I appreciate the smiles that when I say flexibility versus what now the ELD is constraining you with. Labor shortage. We know that there's, the unemployment numbers are so low right now. That's causing there to be a challenge on finding truck drivers and other laborers that impact into the freight industry. The e-commerce or Amazon effect. It's become requisite that I order something today, I expect it to be at my house tomorrow or the next day. That's a transaction that previously may have taken as long as it took for an LTL provider or a truckload to move them, distribution center, into wherever. But now that last mile, that postal impact is obviously going to have an impact on the freight markets. And then that capacity crunch that occurred in 2018 is it's the culmination of all of these pieces coming together. So let's talk a little bit about who and what type of companies are naturally exposed to freight market volatility. But first, I want to make sure that it's clear as I talk about some of these companies and some of them being trucking companies. Some of you are thinking about this in all likelihood as being a physical contract. What about the trucks? These are financially settled futures contracts. No truck is going to bump the dock, ever. If someone wants to ask the question afterward, but what about the truck? Please do, because we will enjoy answering that. No truck is going to bump up against the dock. This is a financially settled futures contract. But what kinds of companies are going to be impacted and are impacted by volatility in the freight markets? Obviously, trucking companies, of which there are 4,500 plus that have more than $20 million of revenue per year. I talked about shippers, the manufacturers, the distributors, the folks who are actually putting the freight onto the trucks for it to then be moved by the trucks. There are 20,000 shippers in the U.S. that spend more than $10 million on their freight, on trucking their freight per year. In between those shippers and those trucking companies are freight brokers, intermediaries, 3PLs. 1,600, greater than 1,600 freight brokers have more than $10 million of revenue per year. So carriers, shippers, intermediaries all have enough scale and have enough companies to provide support to this kind of market. And what do you need to build a liquid futures market? We discussed you need a large, we certainly got that, $750 billion, and volatile market. We certainly have the volatility. We showed that over the last 5 years. You need a benchmark index, DAT, who's represented here and is very open to providing support and answering your questions. They are the benchmark index within the transportation, within the freight industry. They are that trusted index. You need the exchange. You need the clearing to take place for the market. Addison will describe how Nodal does and will provide that in our futures market. And finally, the evangelization, the marketing, that market data, the news and insights that will provide transparency for the futures market will come from FreightWaves. How large is the potential for the contracts and the contract market? We approximate 40 billion miles being available within this market size, which at the contracted rate, and Tom will talk to you about this, at 1,000 miles per contract, that's 40 million futures contracts. So it's large enough. The scale is certainly there. Timing is right. The timing is right now. And with that, let's talk about the exchange and the clearing, and I'll hand it over to Addison Armstrong. Addison?
Thanks, George. So, show of hands in the room, people familiar with futures contracts? Not many, right? So, I think the most important thing to understand is the role of the exchange and the clearinghouse in this product. Now, the Nodal Exchange is our partner. They are one of the leading energy clearing firms in the country. They compete against the likes of the CME and the Intercontinental Exchange, and also NASDAQ to some extent. NASDAQ about 4 years ago started to release some energy contracts into the market. So Nodal focuses primarily on the power markets, and the name Nodal actually refers to the specific segment of the market they deal with, which is an interesting parallel to trucking, because what Nodal does is, instead of trading at big hubs like the Southeast or up in Western Pennsylvania where the PJM hub is, they specialize in going down to a more regional, more local level, much like trucking. There's nodes in trucking and there are nodes in the nodal market. So when we started talking to the people at Nodal about this product, they got it. Another characteristic of electricity is that it is not, you can't store it, right? And much like trucking, you can't store trucking. It's on demand. So those are the two parallels that caught the interest of Nodal, and they felt like this was a market outside of energy that they wanted to get involved with. Now, what does the Nodal Exchange provide to our marketplace and to our marketplace participants? First, it provides the pricing, the credit, liquidity risk management, all of those tools that are part of trading in the futures markets. So what do we say? What do we mean when we say credit? So in an exchange-traded environment, the clearinghouse acts as the counterparty to all trades. So they're the buyer to all sellers and the seller to all buyers. They act as the guarantee in the middle. So if you trade a trucking freight futures and you're a shipper, chances are there could be a number of different counterparties on the other side of the trade. It could be a carrier, it could be a 3PL, it could be a hedge fund, it could be a bank. You'll never know who was on the other side of that trade, because the Nodal Exchange stands in the middle and provides the financial guarantee and also the performance guarantee on the contract. So Nodal also has a clearinghouse, which handles all the financial transactions that are part of clearing a futures contract. Primarily, they're involved in determining what the initial margin will be. So when you trade a futures contract, you have to post basically a performance bond. So if the underlying notional value of one of our lanes is 1,000 miles times $1.50, so it's $15,000, right? Generally, in futures markets, and we don't know specifically yet because it hasn't been determined by our partners at Nodal what the initial margin will be, but generally speaking, it's somewhere between 6 to 10% on a contract. So in this example that I just gave, $15,000, you would have to post $1,500, say, if we use the 10% figure, in order to control that contract. And then on a daily basis, that position is then marked to market, meaning if you bought 1,500s and the next day it was worth 1,550, well, you're in the money and you don't have to post more margin. But if the next day it dropped to 1,450, you would have to put in more money to get back to that level of initial margin. So there's initial margin and then there's maintenance margin. And the exchange determines what those levels are. The other thing is, so we talked about volatility. A lot of times in futures markets, when markets get wildly volatile, the exchange and the clearinghouse will change the margin methodology. So what you were paying maybe 6 or 8% to hold on to the position, they'll raise that in order to sort of tamp down volatility in the short run until the market returns to, call it equilibrium, and then they'll change the margin parameters again. It's not that dynamic. You only see changes in margin when there are significant volatility moments. But that's one way that they manage the risk, right? Because at the end of the day, you want to make sure that your money if you trade out of the position, you're going to get your money back. And if there is a default by someone else in the marketplace, that it doesn't impact you. So that's another way they manage that risk. So the clearinghouse provides that function. There's also, and I'll go to the next slide here for this. So in order to participate in the trucking freight futures markets, which is, for now, it's a commercial marketplace. It's not a retail marketplace. So individual traders will not be able to trade these contracts for some time, maybe later in the year. There will be a change. We're not sure exactly when that will be, but it's something that the Nodal Exchange is working on. But for now, it's a commercial product. And so two things. You have to, one, become a member of the Nodal Exchange. It's a 7-page document. It's not that complicated, but you have to fill that out as part of the onboarding process. The other part is, in order to participate in futures markets, you need to have an account with one of these financial institutions. We list them as FCMs, and FCM is a futures commission merchant, or another way of saying a clearing firm. All of these firms are members of Nodal and will provide clearing services for market participants. One of the things that we're doing, particularly as there are a number of institutions that are unfamiliar with the futures markets, is if you show an interest and tell us that you want to trade this, we will connect you with one or more of these banks or brokerages to help you go through the process of setting up a clearing account. Normally takes somewhere from 4 to 6 weeks. So if you are interested, please let us know so we can get you in the pipeline and move you through there. The FCMs on a day-to-day basis are the ones that are responsible for contacting you in terms of your margining and your positions. It's like having an account at Schwab, right? So every day you will have a position file that will be sent to you from the FCM. If you need to top up your margin, they'll let you know. You have to do that on the day. So if you traded today, the contract settled tonight, it's what's called T+1, trading day +1. You have to levelize your margin to what the requirement is, and if you don't, the brokerage or the bank can close you out of your position. That is a standard across all futures markets. And so that brings us to how you would actually execute a trade in this marketplace. Nodal provides a matching engine as part of the exchange function. So all the bids and offers, it's called the central limit order book. The Nodal Exchange is actually owned by Deutsche Börse, a big European exchange operator with very robust systems, a very well-established company. Part of that merger with Deutsche Börse is that they now use this T7 matching engine at the Nodal Exchange. With that comes a trading platform that you can access via the internet directly to the Nodal portal. It's powered by an industry leading vendor of trading software called CQG, which is very well known in the futures industry. So you can execute your trades there. Tom's going to actually show an example of trade execution when he comes up here. There's also the ability to do what's called a block trade, which is a larger, actually a block of futures contracts. It's not yet determined what the minimum block size is going to be for our product, but in this way you could work with a broker on the phone, and the broker on the phone, you could say, I need to sell this and I want to get this price for selling it. The broker then goes out and finds the other side of that trade, and then the broker's responsible for taking that block of futures contracts and putting it into the clearinghouse on your behalf. And that's all done through some paperwork. You say that I appoint this broker as being allowed to do that on my behalf. And then the final way will be through our own Sonar platform. So if you're a subscriber to Sonar, there will be a link on the platform where you can go straight into the Nodal T7 trading platform and access the market that way. All right, with that, I think I'll turn it over to Tom.
Thank you, Addison. Again, my name is Tom Mallon, and I'm going to take you through some of the highlights of the futures contract specs. First, I'll talk about the network of contracts that we have put together in conjunction with the Nodal Exchange. and our index partner, DAT. We've created a network through analyzing, the vast network that DAT covers. On any given day, DAT is assessing about 18,000 origin destination pairs or point-to-point cities. And from the 18,000 or so origin destination points, we narrowed it down to 6 cities, which will comprise 7 lanes. And those 7 lanes are on the West Coast, the lane between Seattle and LA, the lane between LA and Seattle. And from those lanes, we've created a regional index on the West. In the South, we've got the lanes between LA and Dallas. We're in Dallas, and Dallas back to LA. And so that would comprise the South. And then in the East, we've got the triangle between Chicago to Atlanta, Atlanta to Philadelphia, Philadelphia back to Chicago. And those 3 lanes will comprise the East. And from that, we've created a national index as well. So out of those 6 cities, we've created up to 11 futures contracts which will be listed and traded on the Nodal Exchange beginning on March 29th. And what these lanes allow for is essentially for the industry to de-risk their exposure to the volatility and spot rate transportation costs. And the reason why we've selected these lanes and these cities are, the cities are very large transportation hubs, number one. And number two, the lanes themselves roughly carry about 23% of all freight that's moved nationally. And from that, there's a direct correlation to about 84%. So these are very liquid lanes, number one. And number two, there's a high correlation to the rest of the US. So that's the rationale behind these lanes. I touched upon the 11 contracts and the cities and lanes that comprise those 7 lanes, as well as the 3 regional averages and the national average. The contracts themselves, these are monthly contracts. They are cash settled contracts. As George said, a truck will never, ever, ever show up. And because they are financially settled. They are settled at the end of the month on the DAT average, the monthly average, which is comprised of the daily price that DAT produces or assesses for each one of these lanes. The contract size itself, it's 1,000 miles. That is the standard for the contract. They are priced in dollars and cents per mile. So given today's prices on any given lane, roughly about $1,500 is the notional value of a contract today. Currency is US dollars, and you'll be able to trade these contracts out forward up to 16 months. So there will be a forward curve of 16 months of futures contracts that will be available for trading. The daily settlement, I'll talk about the daily settlement. The daily settlement is based on trading activity that will take place on the Nodal Exchange, as well as input from both DAT and other market participants. So on a daily basis, these contracts are settled by Nodal based on trading activity. The final monthly settlement is based on the DAT average of daily price assessments that they make for the futures contracts. And just a little bit more about DAT. They are the largest price assessing agency in trucking and transportation. If you're familiar with energy, they are akin to Platts in energy. As I said, they assess about 18,000 origin and destination points. From those 18,000 origin destination points, they collect about 256 million electronic transactions, which comprises about $60 billion worth of freight. What I want to do right now is take you through a quick simulation of how a trucking freight future could be traded. As Addison alluded to, there are a number of ways that these contracts can be executed. One of those ways is through the FreightWaves Sonar platform. So I'm just going to give you a quick illustrative overview of how that could look. So what I've done is I've brought up the FreightWaves Sonar platform. This is the trade simulation component that we've built into it. What you'll see on the top part is the account information that gets set up by the FCM. Addison talked about the role of the FCM. One of their roles is to establish the account, establish the appropriate credit limits for the account, and establish the appropriate margining requirements. In the middle component are the lanes that would be available for trading. In this scenario, what we've done is we've put in the three regional and the national lane. The bottom part is where you as a trader can look at your positions, meaning those positions that are open in the market, whether it be a long position or a short position, or a closed out position, as well as any profit and loss that is realized from trading. You can also manage and look at all of the orders that you have entered into the market. On the left-hand side is my market data screen. So this is actual data from Sonar itself. And what I have here is the Eastern average, which is the triangle between Chicago, Atlanta, Atlanta to Philly, Philly back to Chicago. If I want to put a trade into the market, and in this example, I'm going to take the viewpoint of a shipper who is naturally short in the market. He's looking for capacity. In that case, if he's looking at the rates, and when I was looking at my chart, I noticed that in the East average, rates have been fairly depressed, though they are beginning to rise again. And so as a shipper, I want to protect against rising rates. So if I'm looking at my portfolio of freight that needs to be moved over in the next couple of weeks, in this example, let's say I need to move about 20,000 miles worth of freight. That would equate to 20 futures contracts. And so since I want to protect myself against a rise in rates, I'm going to buy 20 futures contracts. Looks like the Wi-Fi is a little slow. Anyway, I put in an order to buy 20 futures contracts. I would get a fill up here in the right-hand corner. And in my positions, I would see that I would be long 20 futures contracts. As I go out to the market and I secure my capacity to move my freight, I'm going to want to unwind that position. So I would go back into the market. I'd go back into my March contract, and I would place an order. And in this case, I want to sell or offset 20,000 miles of futures contracts that I had bought. So I'd go into the market, and then I would, in turn, sell those contracts. After that transaction takes place, I would be flat, meaning I would have no position in the market, and I would have achieved my hedge. So that's just an example of how trucking freight futures could be used in the market. And with that, I'm going to turn it over to Kyle Lintner. Kyle is from K-Ratio, one of our partners, and he is going to walk you through some use cases.
Good afternoon, everyone. My name is Kyle Littner. I'm a principal at a firm called K-Ratio. We are an NFA member firm, CFTC registered CTA. It simply means we're allowed to offer opinion, advice, consultancy, and risk management related to futures trading accounts. With that, I thought we'd dive in. I will repeat, I know you heard it earlier, but 40% of S&P 500 companies cited higher transportation costs as the key driver for decreased profitability in 2018. Simply put, this is something that doesn't just stick around for today and tomorrow. This is a loss that carries forward for the quarter, carries forward for the next year. If you are a public company, this will lower your stock. This will also lower investor confidence. If you're private, you have a lower EBITDA. This is compounded by your industry multiple. We're talking about decreased enterprise value. It's been estimated that 5 to 14% the cost of goods sold is transportation spend. That is a very large number that currently and until March 29th is unhedgeable. For the shipper, we're talking about taking a variable cost moving it to a fixed cost. 2018 saw year-over-year 30% increase in prices. Contained within those 30% were volatility swings of greater than 60%. That's an extremely volatile market. That's a large increase. Like I said, this is something that hasn't been able to be hedged until March 29th. What you can do is take the perceived market rate when this opens and lock in that rate so you're able to operate your business going forward at whatever rates you've seen. You'll also provide guidance as to what you will spend going forward. Visually speaking, here you can see the large run-up in the summer of 2018. You can see where we currently stand now. It is the lowest rates since 2017. This is an ideal time for a shipper to lock in rates going forward. On the other side of it, we have the carrier. For the carrier, same idea, same fiduciary responsibility, but instead of cost, we're talking about locking in revenue. Take the variability out of it, make it fixed. Same guidance estimates going forward, what you're going to get for your trucks. Same chart, national average, 2018. We see the summer peak. We see where we sit today. Had this tool been around, you would have been able to hedge and lock in those rates in the summer when we all thought they were going to $4 or above, and we were all wrong. This allows you to operate your business more profitably. Your operating revenue will be higher. If you'd like to expand your business, buy more trucks, you're doing it at a higher level than you could get now. The interesting take on all of this is for the 3PL. This is fixed operational revenue and fixed carrier expenses. It's our position that a 3PL will operate going forward as both a carrier and a shipper. They will be long, they will be short. Some people say this is delta neutral. It is not. These are different products with different ideas. You have varying levels of gamma introduced into this marketplace. The simplest, most obvious, the 3PL operates like a carrier. We'd like to lock in revenue. Obviously, when rates are elevated, or if you want to do it for the entire year or 16 months going forward, put your short position on a macro level, such as the national average. You've locked in your expected revenues. The twist is the expense. The vast majority of 3PLs seek truck capacity for spot business and contract business. This is effectively a spot market. You are naked and unhedged in the market. Pick a specific lane, find the correlation to what your book of business is. In this example, we have LA to Dallas. You see the volatility, you see the peaks, you see the valleys. You can take your contract or your spot business, price your capacity in this market going forward, and eliminate the risk associated with that. This is no different than what a shipper would be doing. You would operate as a carrier and a shipper at the same time. In this instance, we could go ahead and price ourselves more competitive for this year's RFP and next year's RFP because you will take the risk out of your market and place it into the futures market. I understand some of these topics are a little bit complicated. If you'd like to discuss them further, I will be around, as well as my business partner, Patrick. I myself have over 20 years futures experience, the last 15 of which trading my own accounts in stocks, bonds, currencies, commodities, options. Aside from myself, we have a whole team of statisticians, mathematicians, NASA engineers. We are also the subsidiary of a 22-year-old asset light and 3PL ourselves, so we have every angle covered. For more information, you can also visit k-ratio.com. With that, I'd like to open it up to questions and invite the panel back up. Right off the bat, yes.
Good afternoon. How are the shippers being made aware that they're able to sell futures of their projected shipments?
You guys want that one? How are shippers being made aware?
Yeah, I mean, this is actually one of the ways we're making shippers aware. We're making everybody aware through a series of roadshows. In addition, we've got, salespeople that are actively talking to shippers, whether it be big shippers or small shippers. So it's an active and ongoing educational process leading up to March 29th, the launch. And obviously, there'll be a lot of work to do after the March 29th launch as well.
One more question. And what is the expected rate at the launch at March 29th that you'll be selling the futures at on the shipper and the carrier side?
I'm not quite sure I understand your question. We don't. I mean, there's no way to say what the bid ask is going to be on the first day, but we do expect a vibrant shipper, 3PL, and carrier audience participating in the market on that day.
for those not experienced in futures markets, I've seen a few of these launch over the years, and it is typical when a product first comes to the marketplace that the bid-offer spread is quite wide. You know, both participants or both sides of the trade, to some extent, are trying to protect themselves, right? They don't want to make a price that is you know, easily picked off, because then they're wrong. You know, that's one of the reasons why we're out having these roadshows. It's one of the reasons why, beyond the commercial marketplace, which many of you represent, we're also targeting the hedge fund, the financial community, the banks, the brokerages, in order to bring more liquidity, because it is liquidity that helps to shrink that bid-offer spread over time. But I think, just to be honest and to give everyone a correct expectation, that in the beginning there will be a spread that has to be crossed, and we're, you know, hopefully we've got the right market participants from day one who are willing to stand in there and make a price. These gentlemen, Tom and George and their teams, have done a fantastic job of marketing this product over the past year. We have people who are ready to come in. We have companies ready to come into the marketplace on day one. But again, we have no way of knowing how wide the bid-offer spread will be.
Will the DAB benchmark be based off the broker-to-carrier spot or the shipper-to-carrier contract rates on DAB?
Sorry, could you repeat?
For the DAP benchmark, will that be based on the broker-to-carrier spot market rate or the shipper-to-carrier contract rate?
It's on the DAT index and the DAT spot market index.
Okay.
So the 60 billion or so of freight that's derived from those 250 some odd million transactions is where that 60 billion is derived, and it's the spot market.
And based on loads that are actually picked up, so it's not indicative. It is these are loads that have actually been picked up and prices electronically submitted to DAT.
How do you validate against that? I mean, that's right now it's broker submissions to the DAT.
Right. Right, and actually we could talk about this later. We've got DAT is represented here. We can talk about it afterwards. But there, in all of the indices that DAT provides, there is a cleansing process that allows them to understand that there's no one shipper that's dominating any particular lane, nor is there any one broker that is able to manipulate the market based on the way that they're cleansing, the way that they're validating on the size of the impact that that particular broker may be having on any one of those 18,000 lanes. So the index that these will be settled against is going through that same process and same cleansing process that DAT does today. And just one more thing, when I talk about spot versus contract, I would tell you, read freightwaves.com. There is no such thing as a contract rate, right? Right? I mean, anybody in the industry is going to say it's a fallacy. It's a paper rate. You know, it's an agreement that has no legal binding. There's nothing behind that. So there is going to be some of that contracted freight that works its way. You know, last year, you know, if you go into the year with an expectation of 95% of your freight being covered in the contract market, last year, if you covered 70% with those contracted carriers, you probably were doing a pretty good job. If there's a lot of that middle freight that ends up, you know, being driven to and is where DAT drives so much of its value, that will also be included in this.
You go back to what an early product kind of evolution looks like with a new product launch here. You know, how long does it usually take to know when things are successful, liquidity is stabilized, and the spreads start to get a little bit more manageable? And how are your conversations going with the market makers and liquidity providers in the early part of this?
Sure. So I'll start with the back end of the question, which is the liquidity providers. So we are in conversations with a number of different entities to provide two-way markets on the screen. And so we expect a handful of liquidity providers making two-way markets on the screen day one. As far as, you know, when do you know if a contract is successful or when it's not? I mean, very difficult to say. I mean, we looked at what happened, Nodal's experience with electricity. And it was roughly about 18 months or so before you started to see, a significant upturn in volume. And a lot of things go into that. It could be, simply participants becoming more comfortable with the contracts, identifying, the various use cases, or something structural happening, or an event which, where one company, had used a futures contract and protected themselves against an event, and that becomes known, and then everybody else gets into the market. So, in oil, OPEC was a huge driver. The influence of OPEC on the oil markets was a huge driver for the NYMEX WTI contract becoming as liquid as it was. So we expect those types of events to happen, in trucking. Some of them have already happened, as George described in the why now. So I think 18 months is a reasonable, approximation for takeoff. And Craig's been at this a long time, a couple of years. And so, we're in it for the long haul. So.
First off, congratulations on the development of all this. It's very fascinating. In regards to the upcoming volume and the volatility that's inherent within this market, do you foresee possibly a VIX of freight? Would the volatility be traded at some point in the future?
I think the answer to your question is yes. Not day one. These are the monthly contracts that we're going to go live with day one, but there will be natural evolution of product, whether it be a new product like a VIX, whether it be shorter duration products, other than monthly. Obviously, options, if liquidity takes hold, will be another, advent to the product. So
Possibly
yes.
leveraged contracts as well?
Yes.
Excellent. Thanks.
A follow-on to the question earlier about how long you think it might take to get to market maturity. So when you do get to that, or when the market does get to a relatively mature level, what percentage of the market might you envisage would be traded in the futures in this market? And I'm just curious, what do you think is a likely target?
We've estimated that up to 40 billion miles are subject to spot rate volatility. So, obviously we're looking at, the likelihood of a market, if it takes off, being upwards to about 40 million contracts traded. So a very, very big market. And if you put that into comparison with other markets, that's roughly the size of the natural gas market that's traded today.
Okay, thank you.
Do you expect to see a lot of shippers come into this market? And I guess kind of a follow-on question, I see more of the kind of the arbitrage play with your 3PLs and your brokers, and them, potentially making a lot of money off the spread of this thing, since, they're not contract, they're buying for their own book and sell it at whatever rate they want to, basically.
The answer is yes. Go down two roads there. One, in the initial stage, our thoughts are those shippers, and again, the definition for shippers is not somebody with boats, but is someone who puts the freight onto a truck. The shippers that are already trading, doing a futures trade in commodities of some sort, so they've already got a treasury department, they've already got a finance department that's used to this. It will be a challenge for us. As many times as we say to the shipper, a truck is not going to bump up against your dock. It's going to be very hard conceptually for the folks like me who bleed diesel fuel to really understand what's going on. But those who already have and are trading, we think will be first into that. And then the second part where our confidence comes from is we have been evangelizing and marketing for the better part of well over a year, and Craig's gone well longer than that. And 2018 was the perfect year to have in advance of this occurring. The volatility, with the spot rates going up as much as they did, really harmed, as we described, as Kyle described, as we described the publicly traded folks describing what they had to do in order to try to deal with those. So that's caused a number of not only the folks who are already trading commodities, but folks that you would not necessarily expect in retail and others to come to us and want to be potential early into this market.
I'd like to say, just in addition to it, obviously there's the direct benefit to all that participate, but as an ancillary benefit to everyone is this provides price transparency to all. So specific to the 3PL, part of what they're doing already is acting like a market in a sense, is that they're buying loads and they're selling capacity, right? So now this is broadcast for all to see. Those that adopt it the best will remain competitive, because those that don't are subject to whatever the market dictates as price.
So from my understanding, I don't know much about futures. We're in transportation as a 3PL. My understanding is that a future helps kind of hedge your risk against volatility. And as a 3PL, how can we use this to become more competitive against our competition?
Sure. So initially, like I mentioned earlier, the complete macro level would be locking in your expected earnings or your expected revenues for your spot market business if you want to do it. Contractually, that's a little different, but you can do that as well. Specific to the contract business, or the RFP, however you want to frame it, that business allows you to lock in a fixed rate in the futures market. So you can honor your commitments to your shipper instead of losing your primary status at whatever percentage you have you're obligated to. You never have to worry about rates skyrocketing and trying to find a truck at whatever price that may be, because you've already purchased the price in the futures market. So for however many months that you seek out coverage, you're effectively locking in that rate in the market. So whatever you do operationally in the real world, those gains or losses will simply be offset financially at the exchange. There is no truck, yes. But that's the beauty of it. So that is the beauty of it, though, is all we're doing is dealing with the financial aspect of it. So operationally, yes, you still have to go find your truck, but it doesn't matter what you paid for it.
Are you bringing blockchain or distributed ledger information into this to be able to help create the trust network of participants getting involved?
No. That's short answer is no. Blockchain is not factored into this.
Yeah, initially, yes. Tom's right. No, initially, but certainly there's the opportunity to put the trusted ledger place in there. Yep. Very true. And what Kyle said, transparency is going to be facilitated in a way that's never been done so before.
So you guys are about midway through the trucking roadshow now. What's your take from the asset-based carriers on this? How are they responding to this exchange?
Extremely well. I've had the opportunity outside of the road shows to participate in a number of the publicly traded top 10 truckload carriers whom Tom and I have made visits together to many of them so that they would be understanding of the early adoption, what it would take to be early adopters. Numbers of them have told us if this existed in 2018, it would have been extremely beneficial. But again, go back to thinking about volatility and where we are today around rates, compared to June or so of last year. volatility obviously goes both ways. So we've had extreme amounts of interest from the truckload community, and I would expect numerous of the largest to be very early adopters.
I can see how this can be kind of attractive, of course, to large shippers who are already in the market and large asset-based carriers who are already in market. But how do you plan to connect with the smaller 3PLs, smaller carriers that really, at some point, make that market and make that price? Right now, it's very volatile, and carriers are dying. 3PLs are staying in a good space. However, if you can't afford a truck, you can't move it, which in my eyes of what I'm seeing right now tells me there will be a dip in that futures. Have you did any projections on that and how you plan to attract those people, like the smaller shipping companies?
Yeah, like many of us know, I believe the figure is 91% of all carriers are 10 trucks and less. So the vast majority of this marketplace is small. It's completely fragmented. So at a minimum, this market will provide price transparency to all. As it works in the real world, the larger boys tend to dictate the price. That'll happen in the futures market as well. As far as participating in the market, if they can't meet the financial requirements individually at the exchange, there are some ideas possibly in other commodities such as agriculture. There are co-ops where a group of carriers could band together, pool their resources, and they would be able to participate as one entity divided down below to each specific company. So initially, it will probably be adopted by the larger ones, like George mentioned. It makes complete sense to them. Obviously, it's a tool for the smaller as well. How we get there, I'm not exactly sure. I have a rough idea, but there will be a way for all to participate. Yes, all industry participants.
Chattanooga is well represented, I'll put it that way. Earnings of the publicly traded carriers had a lot to do with the price at the pump. Talk about it later. Talk about the spread at when we go out and have a soda together. Else? Yeah. Yep. Yeah. That will include. I guess I would describe that as, think of one of the behemoth carriers that has multiple modes. So that will include surface transportation, so less than truckload, dedicated will be in there. All of those types of moves. Now, what we're talking about here is initially those 7 lanes that'll work, but there's nothing that will keep nothing. Yeah. Right. So. Yeah. And again, that's the leaping off point that we think has plenty of opportunity and liquidity there. And you are representing 23% of the total market within those lanes that we have. So you've got a representative, large enough statistical representative sample to be able to trade against it.
We are still debating whether to launch all. Where we stand right now, minimally, we'll launch the 3 regional and the national on the screen. But the others likely would still be able to be executed, whether it be through a block transaction or some other mechanism off the screen. But minimally 4.
Well, thank you again for joining us on President's Day. Please stay. We're here and very interested in talking about it and chatting about this with you. Thank you very much and appreciate everyone joining us. Thank you.